$10,000 will change your life more than $1 million will. Not more than the first $10,000 you ever saved. More than the millionth dollar, the one everybody is actually aiming at. And the gap isn't close. Here's what this video is. 9 levels of net worth, ranked worst to best, using U.S. household figures from the Federal Reserve's Survey of Consumer Finances and U.S. tax rules. The ranking isn't the size of the number, it's 3 things. How many months you can survive without income, how much the money produces on its own, and how many decisions it lets you refuse. Those 3 tell you what a net worth actually is. The number by itself tells you almost nothing. One level on this list is where 1 million people believe their life will change, and the arithmetic says it barely moves at all. By the end of this video, you'll know exactly which net worth level is worth what it costs you to reach, and which ones quietly take it back. Start at 0. Not broke. 0. Assets equal liabilities, and the balance sheet nets to nothing. Plenty of people are below this line. The average federal student loan borrower carries somewhere around $38,000, and roughly 1 in 4 car trade-ins in 2025 was underwater, with average negative equity near $6,800. The number that defines this level comes from the Federal Reserve's own household survey. About 37% of American adults could not cover a $400 emergency with cash or its equivalent. Watch what that does. Your alternator dies. $400, and the only instrument available is a credit card at roughly 22%. You pay $25 a month, which feels manageable. It takes 19 months to clear and costs about $77 in interest. And somewhere in month 7, something else breaks. 0 ranks last because 0 isn't neutral. At 0, every ordinary event in a normal life converts directly into debt at 22%. $10,000 is the single biggest jump on this entire list, and almost nobody frames it that way. It's about 6 weeks of spending for an average American household, which runs somewhere near $6,400 a month according to the Bureau of Labor Statistics. 6 weeks doesn't sound like freedom. It isn't. It's something more useful. It's the end of the credit card as an emergency system. Run the arithmetic on that. Staying out of a $5,000 revolving balance at 22% saves you $1,100 a year, every year, with no market risk and no waiting. There is no investment on earth that reliably pays 22%. Not paying it is the closest thing that exists. And the money works while it sits. $10,000 in a high-yield savings account at 4% throws off $400 a year, which happens to be the exact size of the emergency that used to wreck you. 10,000 ranks 8th on the raw number and 1st on impact per dollar. This is the level where the floor stops being made of debt. 50,000 is the first level where you get to say no. The median American household under 35 held about $39,000 in net worth in the 2022 survey, so this sits slightly ahead of a typical young household. At $6,400 a month of spending, $50,000 is roughly 8 months of your life, fully funded, with no income arriving. State unemployment insurance replaces something like 40 to 45% of prior wages for up to 26 weeks in most states, so your savings and that combined can carry you well past a year. That's what changes. Not comfort. Leverage. You can leave a job that's damaging you before you have the next one lined up. You can refuse the promotion that comes with the schedule you don't want. 8 months of runway is the difference between negotiating and accepting. One caution that matters more as you climb: $50,000 in cash and $50,000 in home equity are the same number and completely different assets. You cannot eat a kitchen. Left alone at a 7% nominal return, the rough long-run average for a diversified U.S. stock portfolio, which is a historical average and not a promise about your specific decades, $50,000 becomes about $380,000 in 30 years without another dollar added. $50,000 ranks 7th because it buys the first thing money is genuinely good for: the ability to walk away. Charlie Munger had a line about $100,000, that the first one is brutally hard, and that after it, you can ease off slightly. He was describing a real mechanical shift, not giving encouragement. Here's the shift. At 7%, $100,000 generates about $7,000 a year on its own. The U.S. personal saving rate has been running near 4.5% of disposable income, which for a median household works out to somewhere around $3,000 saved in a year. Your money is now saving faster than you are. That has never been true at any level below this. The doubling makes it concrete. At 7%, money doubles roughly every 10 years. 100,000 becomes 200, then 400, then 800, then 1.6 million. 40 years. No additional contributions. No cleverness required. Two people both hit 100,000 at age 30. One stops contributing entirely. At 60, they have about 761,000. The second adds $500 a month and ends with roughly 1.37 million. The extra 600,000 came from a monthly transfer smaller than most car payments. For context, median U.S. household net worth was about 193,000 in the 2022 survey, so 100,000 puts you a little under the middle of the country. 100,000 ranks sixth because it's the level where compounding stops being a concept and starts being the largest line item in your financial life. And a quick note before we keep climbing: this is general information, not personal financial advice. Your age, your tax situation, and what your money is actually invested in will move every figure here. $250,000 is roughly where the median American in their late 40s lands. The 2022 survey put the median net worth for households aged 45 to 54 at about $247,000. 4% of it is $10,000 a year. That's not retirement. It is, permanently, your property tax and your home insurance, or your car, forever, or a full year of health insurance premiums. One recurring bill in your life is now paid by the money instead of by you. This is also where composition starts deciding your outcomes more than the total does. Take someone at $250,000 who gets laid off. If $160,000 is home equity, and $30,000 is a 401k and $60,000 is actually liquid, they have 9 months of runway, not 4 years. Reaching into that 401k early costs real money. A $50,000 withdrawal before 59.5 triggers a 10% penalty plus ordinary income tax. So in the 22% bracket, you hand over roughly $16,000 and keep 34. You paid a third of it for the privilege of urgency. One structural detail worth knowing: FDIC insurance covers $250,000 per depositor, per bank, per ownership category. This is the first level where the question of where you keep it stops being academic. $250,000 ranks fifth because you've reached the middle of the country and discovered the middle of the country is not liquid. $500,000 changes the question you're asking. Below this, the question is whether you'll be okay. Here, it becomes what you want. The 2022 survey puts this somewhere around the top third of American households by net worth. 4% of it is $20,000 a year, enough to cover the mortgage payment on a median-priced home or a family's health coverage, indefinitely, without touching the principal. The number that makes this level distinct is what happens if you stop. $500,000 at age 35, left invested at 7% nominal, with zero further contributions, reaches about $3.8 million by 65. Adjusted for 2.5% inflation, that's roughly $1.8 million in today's purchasing power, which is a genuine retirement, funded entirely by money you already have. That's the real unlock, and it's psychological as much as financial. You still have to work. The money can't replace your income yet, but you no longer have to save. Every dollar you earn from here is available for the life you're living right now instead of the one you're insuring against. Most people never notice they've crossed this line. They keep saving at the same rate out of habit, deferring the same things, and arrive at 70 with a portfolio optimized for a version of themselves who no longer exists. $500,000 ranks fourth because it's the first level where the correct move might be to spend more, not less. Here's the level I promised you at the start: $1 million. Culturally, this is the finish line. Mathematically, it produces $40,000 a year at a 4% withdrawal rate, the figure from Bengen's original 1994 work and the Trinity study that followed. Built for a 30-year horizon, median U.S. household income was about $81,000 in 2023. A millionaire's portfolio, drawn safely, generates half of what a typical American household earns. Inflation explains most of the confusion. $1 million in 1985 is worth roughly $3 million today. The word millionaire is a 1980s word being asked to do 2026 work, and it can't. Composition makes it worse. For most American households at this level, a large share is home equity and retirement accounts. If $400,000 is your house and $500,000 is a 401k, locked until 59 and a half, your actual spendable wealth is $100,000. You are a millionaire with 6 weeks of liquidity. Here's what it looks like in practice. A 55-year-old with $1 million, spending $70,000 a year. 4% gives 40. The gap is $30,000 annually, which means either cutting spending by 43% or working longer. Working 8 more years while adding that $30,000 a year gets the portfolio to roughly $2 million, which at 4% produces $81,000, and the problem is solved. 8 years. That's the actual distance between a millionaire and a retired person. For placement, roughly 8 to 9% of American households have a net worth above $1 million, and the threshold for the top 10% sat near $2 million in the 2022 survey. $1 million ranks third because it's the first genuinely secure level on this list, and the last one that people consistently mistake for freedom. $3 million is where the tax code switches sides. 4% of $3 million is $120,000 a year, above median household income, indefinitely, without spending the principal, but the headline is what you keep, not what you draw. If that $120,000 arrives as qualified dividends and long-term capital gains, rather than as salary, a single filer pays 0% federal on long-term gains, up to about $48,000 of taxable income in 2025, and 15% above that, up to $533,000. The net investment income tax of 3.8% doesn't start until $200,000 of modified adjusted gross income. Realistically, a well-structured $120,000 of investment income can carry a federal effective rate in the single digits. Compare that to a $120,000 salary, where federal income tax and payroll tax together land somewhere around 22%. Identical lifestyle, roughly half the tax bill. That gap, between money you earn and money you own, is the entire reason wealth accumulates faster than income at the top. The honest complication is sequence risk, and it's the thing that actually kills portfolios at this level. A 2008-style drawdown of 37% takes $3 million to $1.89 million. Continuing to draw $120,000 from that is a 6.35% withdrawal rate, well outside safe territory, in the worst possible year to be selling. The number on the statement doesn't protect you. The allocation and your willingness to cut spending in a bad year do. $3 million ranks second because work becomes genuinely optional, and because the tax code stops charging you for existing. $10 million puts you in roughly the top 1 to 2% of American households. The 2022 survey put the top 1% threshold near $11.6 million. 4% is $400,000 a year. At a more conservative 3%, $300,000 a year, with the principal growing behind you. Almost no lifestyle question is a money question anymore. Here's the number that matters most at this level, and it isn't a return. It's a fee. A 1% advisory fee on $10 million is $100,000 a year, a full professional salary paid annually, whether the portfolio rises or falls. Run it forward. $10 million compounding at 7% for 30 years with no withdrawals reaches about $76 million. The same $10 million compounding at 6%, identical portfolio, 1% shaved off the top, reaches about $57 million. The difference is $19 million. That is the largest single figure in this entire video, and it was produced by a decimal point. This level beats everything above it because it's the first where your money outlives the decisions you make about it. At every level below, a bad decade, or a job loss, or a divorce can genuinely reset the project. Here, the portfolio is large enough that a serious mistake costs you optionality rather than security. The honest downsides are real, and they're the ones nobody puts in the thumbnail. Wealth at this level is usually concentrated. One business, one company's stock, real estate in one metro, which means the diversified math I just walked through often doesn't describe the actual portfolio. The federal estate tax exemption sat near $14 million per person in 2025 and was raised for the years after, so a $10 million estate is likely under the federal line, but several states set their thresholds far lower. Oregon at $1 million, Massachusetts at $2 million, and that's worth checking against current rules where you live. And the research on well-being keeps pointing the same direction. Money reliably removes suffering caused by the lack of money. Past that point, it stops doing much, and $10 million is well past that point. Every level on this list is buying the same product in different quantities. Not comfort, time. Money you don't have to earn is the only asset that converts into years of your life that you get to direct. The difference between 0 and 10 million isn't complicated. It's the difference between money that works for you and money that quietly works against you. If you want to see what $1 million actually looks like at every age, that video is next. See you there.